Good evening, everyone. So over the past 5 to 7 years, I've had the privilege of witnessing the immense growth very closely in the quant investing space, being a part of ST Advisors. About 5 to 7 years back when these funds were getting launched, all they had was high hopes along with a bunch of backtests. And the performance has been really amazing in the last 5, 7 years. Now, almost investors are actually spoiled for choice. They have options in mutual funds, PMSs, and even the RIAs. Right? So today in this discussion, obviously, we'll want to touch upon the immense opportunities that are there in front of us and also the challenges that we are facing along with how you plan to tackle them. So I've divided this discussion in 3 parts. Primarily, I want to discuss with you how you go about constructing your portfolios in the first phase. And then secondly, a discussion about quant versus discretionary fund management. And finally, I want to discuss with you the use case of AI in quant investing in specific, but also in the wealth management industry in general. But before that, I want to maybe you guys take 1 to 2 minutes to introduce what exactly you are doing and how your strategies and approach is unique. So maybe Sonam, you can start.
No, definitely. See, I am a PMS manager with this company called Right Research. We've been running our PMS for the last 17 months, but we have been doing quant investing in different avatars, primarily through small case platform for the last 5 years. I'm sure I'll have a few of my subscribers in this audience also. But yeah, so see, for me, I started my career somewhere in 2012 and I've not done anything in investing apart from quant. What I've seen is that in the last 5, 7 years, things have really evolved. 10 years ago, if you went and told somebody that you're doing quant, people didn't understand what it is. Now, especially with the performance that is coming out of these momentum-driven strategies, multi-factor strategies, you're seeing people adapt to quant. And I think now that, like, we were seeing examples, right? The market is expanding, so many new opportunities, new companies, new industries are emerging. And you need to be data-driven, you need to be dynamic to make a good return out of the market. And, that's what we try to do with Right Research, and we've done it well for our clients. And yeah, I would love to discuss this in this session, right?
Siddharth, over to you.
So I'm Siddharth Vora and I represent PL Capital Asset Management. I am the fund manager of the equity and multi-asset PMS strategies. At PL, we began the quant journey roughly 5 years back when we started building a team of finance and technology experts to be able to combine the best of human wisdom and machine precision. So over the last 5 years, we've mainly focused on building the entire quant infrastructure to be able to make investment decisions using rules, systems, and processes. And the way we've really gone about it is our basic thesis on investing is only those strategies can outperform across cycles which have the ability to adapt to macro and market cycles. So in our flagship equity fund, which is Aqua, we mainly focus on a flexi-cap adaptive equity strategy. And when I say adaptive, we are adaptive across market caps, which is large, mid, and small. We are adaptive across sectors, which is cyclicals and non-cyclicals. We are adaptive across asset class, which is equity and cash. We are also adaptive across a very important factor that most people overlook, which is the style of investing. In a certain cycle, a value style does better. In another, a growth style does better. In a third cycle, momentum would do well. And in a fourth cycle, quality would do well. So our thesis is that we need a strategy that can adapt across these different style paradigms. And what we've been able to do over the last 4-5 years is build these adaptive strategies. Again, we consume multiple sources of data, whether it's fundamental, technical, macroeconomic, or to a certain extent, alternative as well. And our fund has been live for roughly 18 months now, the equity fund. And yeah, we very bullish on the whole quant space in India. And I think investors are, as you rightly said, spoiled for choice in times to come ahead.
Thank you, Siddharth. Sankash, over to you.
Yep, thank you. I am Sankash, and I'm the founder and CEO of 𝐸𝐸. So 𝐸𝐸 began, I think 5 years back in Hyderabad. That's where I'm from. I dropped out of my college to start the company when I was 18. And then over the last 5 years, we have scaled the advisory business. So we got into investment advisory first. And quant as an idea was always part of our journey, basically. I don't think we have ever seen it as something that we need to add up into our journey. So the philosophy or where our ideas began from is the idea that human fund management, in a lot of cases, there are extraordinary human fund managers, but there's a lot left to do in that space, basically. So billions of dollars of clients' money running at the whims and fancies of an individual sounds very scary, at least to me, basically. So emotions, prejudice, bias, and the speed with which, or accuracy with which that research can be done by computing or with intelligent computing today is at a different scale that the human mind can seldom fathom, basically. So that's where we started, and our approach to quant and the overall research was very, very different from the day one. We wanted to work with the retail clients to begin with, so there was a lot of education involved in the advisory space because we are long-term, was our philosophy, invest based on fundamentals. So asking people to remain patient and do all that education was one part of the thing, and the other part is where we spent on the research side. So broadly, we can say that our research is driven by our 𝐸𝐸 system. So 𝐸𝐸 is our in-house AI system that we have built, which broadly can be divided into 3 sections: Quant, Iris, and Synapse. Quant looks at all the mathematical, numerical, or quantitative data. Again, we'll get into details of how our perspective is different in the quant side. But what makes our system unique is in terms of the Iris, the qualitative aspect of the analysis. So whenever quant models work and help make a decision, there's still a lot of human intuition and decision making involved in that, whether it's the rules or whether it's a bias. So we wanted to eliminate that at a fundamental level. For example, if you're using the GICS, the Global Industrial Classification System, we didn't want to even make an assumption that GICS is what the industry cohorts are. So we started questioning the ground realities. We started questioning everything. Are these really the industries, or are these the companies that are most similar to each other? So from creating those clusters to actually analyzing the qualitative aspects of a company, whether it's corporate governance, ethics, or sustainability, things like that, we've been able to automate most of this research in the company, basically. So we have almost no analysts on our payroll today, and we still advise 3,000-4,000 crores of assets at the moment, and I think this is the future, where maybe not complete replacement, but I think quant and qualitative research complementing humans also is an option that we should be thinking about.
So Siddharth, you earlier spoke a bit about adaptability. Now, can you take us everyone through this process of creating these portfolios so that they are more adaptable to the changing market regimes there?
So I think the source of adaptability comes from risk. Markets operate in different risk cycles. In a certain regime, you want to take more risk or keep a higher beta than the market. If basically we are in a strong macroeconomic cycle with healthy liquidity outlook, and the growth is also coming strong. In a cycle like this, you want to take more risk than the market because investors are in a risk-on mode, the way we look at it. In a risk-on mode, you would look at styles like momentum and value. You would look at cyclical sectors. You would probably have more weight to mid and small caps in your portfolio, and you would keep your portfolio beta significantly higher than 1. So in a cycle like this, you need to bat for scoring the highest runs in the fastest or the least number of balls. As the cycle transitions, we call it the risk transition cycle. In a cycle like this, we're seeing the macro cycle moderating the pace of growth like we are right now. For the last 5 months, our models have been in a risk transition zone. So in a cycle like that, you're seeing economy is moderating the pace of growth. The liquidity outlook is worsening. The corporate earnings are slowing down. And the valuations are usually high because we are coming from a risk-on phase. So in a cycle like this, our models will prioritize quality, will prioritize low risk or low volatility, will increase the allocation to larger caps and larger mid caps, and will try to bring the portfolio beta closer to 1 or slightly below 1. This is a cycle where we believe the focus shifts from returns alone to risk-adjusted returns. And then the third cycle is the risk-off cycle. The economy is not in a good shape. The market sentiment is very weak. Investors are running away from risk assets. This is a cycle where you have large caps, where you have cash, you have absolute non-cyclical sectors, you have low volatility stocks in your portfolio, and the whole focus here is not to make money, not even risk-adjusted returns, purely reducing drawdowns or volatility in the portfolio. So if the markets are losing 20-30%, and if you're able to curtail your loss at 10-15%, you've done a good job. So we firstly start constructing portfolios by detecting which regime are we in. Once we've detected the market and macro regime, then we go around constructing the portfolio using a host of factors: fundamental factors, economic factors, risk factors, liquidity factors, sectors and themes to focus on, and of course technical factors like volatility and momentum. So stocks are selected by giving each security a score on multiple factors, but how much weight each factor gets is dependent on the regime. And that's why we are regime adaptive in a certain sense.
So Sonam, Siddharth spoke about momentum as a factor. Now you have worked a lot on the momentum factor along with the other factors. So what's your take on it? How do you see momentum performing in times like these currently in the volatile times? And also, how do you make your systems, your strategy more robust?
So like Siddharth said, that whenever you are actually going through a regime transition, right? Whenever you are going through a very robust bull market suddenly changing into a sideways market, or seeing a reactionary move, you see momentum stocks take a hit, right? That is the time momentum starts looking scary, and we've seen that happen in the last few months. Right, where price momentum, especially if you're just chasing the high performance stocks, those have corrected. But yeah, I think the power of quant is that you don't just have to look at the prices. For example, when we look at momentum, we combine earning momentum with price momentum. Earning momentum means how are the earnings growing, and how are the estimates sort of reacting. And that tends to be a very, very powerful factor. So, combining price momentum to earning momentum. For example, in the last 4 months, my high-risk momentum strategy has been the best performer, right? And you would believe that my multi-factor should be doing well, but actually the high-risk momentum one has done the best. So obviously, see, all of these strategies, it's an evolving market. Obviously, we all don't know everything. But yeah, the wealth of data, the wealth of number of factors that are coming in is evolving so fast, and you can definitely do good momentum investing in risky times as well. But you sort of have to understand the market condition and understand the benefit that the different data sets are bringing on.
Sankarsh, over to you now. Now, tell me, your approach to quant investing is quite interesting and quite different than what Siddharth and Sonam are practicing. So why don't you talk about your approach a bit and how you are using quant in providing the personalized advice that you are providing?
Sure. So I'll divide this question into 2 parts. One is the approach and how do we personalize, basically. So in terms of the approach, like I said, the first ground truth that we begin from is that we don't understand a lot about the market, right? So we need to understand that first. And especially because reason and consequences may not always be directly correlated, or maybe even we might not even have the ability to pinpoint and say this was the reason. For example, you might have a bad quarter and the stock rises, basically. And you had a great quarter and the stock goes down. So if it were as simple as a mathematical formula, then it should follow a certain coherence across different situations. So there is much more than that. So there are multiple different layers of complexity that we believe is there. So what we do is, one, to give as much autonomy to our system as possible with the least number of rules, right? So we don't tell the system that, for example, quality means your ROC has to be a certain percentage. If I say 15%, why not something that's 15.8 or something that's 14.2, right? So you're hard coding your bias into the system and expecting a different result, which won't happen basically. So we let our systems define what parameters are important and also the ranges or the optimal values that will actually create alpha or are having a higher probability of creating alpha. So that certain understanding that there's a lot we don't know, let the system define it. Of course, it sounds a little scary that we are leaving it completely to the system, but these are supervised systems as well. So over time, we've been able to come to certain conclusions, whether it is industry level clustering or understanding what could be the likely winners within a particular sector, how to differently analyze each sector. I think these are different models that will come together, not a single model, not a single factor, not a multi-factor with a singular strategy, but these are multiple strategies that will come together. I think that's in line with what Siddharth was saying. So that's the part one. So give as much autonomy, give time, give great data, and that's a stepping stone. The second part, how do we customize and why do we even customize? So when I first looked at the advisory space and when we looked at how advice was communicated to the client, I was very astonished that the advisor had a list of 10, 12 or 14 stocks, a kind of a portfolio, and that was being circulated to all clients. Now the advisor or the fund manager might be spot on with their research. There's no problem with that. The problem could be doesn't fit the client's profile basically. So somebody is investing for 5 years, 7 years or 10 years. These are all long term, but they're all not the same, right? So you could absolutely be right about a certain business, but it may not pan out in the time that the client needs to get out of the market. That's one example. And there's a lot of such things that need customization. And there was a discrimination in terms of if you have a higher amount of capital, we'll give you bespoke service, right? But for a retail client, that wasn't available. So that's where we started. And we created a risk profiling system called EFG, the Emotional, Financial, and General Analysis. So this was a psychometric tool that we developed because we understood that clients did not actually understand the questions that we were asking many times, or they were not able to give us an accurate answer. For example, our question was, how much would you risk losing, or how would you rate yourself in terms of risk appetite? I never met a client who said my risk appetite is low, right? So everybody said my risk appetite is high. But until when the market crashes is when you know who has a high risk appetite and who has a low one, basically. So instead of asking just straight dumb questions, we started analyzing their behavior. How do they interact with our system? How many times have they changed their answer to our question? What's the time they have taken to respond? How are they responding to our advice, or in the case of our PMS, right? So we execute, so that issue is not there. So we analyze all those factors, create a profile. That profile then coordinates with our Quant and Iris system to actually give that portfolio, basically.
Siddharth, now there's a general knowledge here in the Quant that these micro strategies that we create, now with time they lose their edge, something which is known as the model decay, right? So how do you identify that if a strategy is losing its edge, whether it's going to come back or whether it's something that you need to discard and work on something new?
So I think the starting point here is to really do high quality back tests to understand in which conditions, in which market cycles your models outperform, in which market cycles your models underperform. There is no model in the world which will outperform across cycles. Every model has phases of good and bad performance. As an investor and as a fund manager, we should be aware of those cycles. That's point one. Secondly, when you construct your models in an unbiased way, in an unconstrained way, you're not defining everything to the T. And, a simple example of unconstrained and unbiased is, you don't decide that, okay, stock A will get so much weight, stock B will get so much weight, stock C will get so much weight. We run an equal weighted portfolio. So that takes off the weighting bias. The second is, we are not benchmark hugging, which means I'm not saying, okay, banks are 25% in the benchmark, so I should be plus minus the benchmark weight. That's a constraint, that's a bias. So you remove those sector biases, you remove security weight biases. You don't define, okay, in a certain cycle you give momentum 50% weight because I think it will work well, or in a certain other cycle give quality 50% weight because I think it will work well. If you have tested your model, you know which factors get how much weight, and that decision is not taken by you, it is taken by the model. And, taking off from what he said, I think we also use something called the principle of relativity, which means we are not defining what is a good quality stock, what is a cheap value stock, what is a high growth stock. All of these things change based on the market cycle we are in. If we are in a cycle like now, in the last 1 year, I don't think 15 PE is cheap. I think 30 PE is cheap because everything is so elevated. If you're in a bear market, probably even 18 PE is expensive. Also, when you see growth, growth is also a function of the macro cycle and the corporate earnings cycle. So in a certain cycle, 12% growth is high growth. In a certain cycle, 20% growth is also low growth. So we cannot define absolute thresholds and say what is good quality, what is cheap, what is fast growth, what is good momentum. It's all a function of the market cycle, and therefore we believe in the principle of relativity. And finally, the way we go about designing the models, the key word here we focus on is repeatable investment outcomes. The moment you take unbiased weighting approaches, whether in terms of stocks, sectors, or factors, and your investment decisions of what to buy, when to buy, how much to buy, when to hold, when to sell, which sector and style to use, how much risk to take. If all these decisions are an outcome of the rules you've defined, you automatically deal with the whole problem of model decay.
Sonam, one of the perceptions in the investors is that Quant is very much focused on data-driven approach, which is correct, but also that we are unable to look at the qualitative factors like the strength of management or strength of a brand of a company, things like these. So what's your take on it? How do you take these kind of qualitative factors into account?
So see, first thing this another misconception that people have is that when you're doing quant, it is like a black box and you don't know what is happening, right? So, somebody who's telling you a story, you understand, okay, this is the theme or story I'm investing in. A quant guy is talking about a lot of numbers and some abstract ideas. I would not understand what's happening inside it. But actually, if you talk to a quant fund manager, they will tell you a much more transparent way that, okay, this is why I invested, because this company had this, let's say, quality, value, or whatever factor that was, and this is why I exited. And this is why I am changing my allocation. It's much more transparent compared to, anything else. And I think you asked me, the second question was?
Regarding the qualitative factors, how do you take that into
definitely.
account?
So, see, I am an investor that I really think that my model maybe has 5, 8, 10 levels to improve, right? So we have not solved anything. We have to learn a lot. And so I actually I attend analyst calls, I attend brokerage conferences, and I see that the analyst who's talking to management, there's a wealth of information. They're doing these deep research, and there's a lot of information out there. And, all these, for example, now with AI, now with so many alternative data sets, you can get data feeds on how these smart analysts are actually putting out their rating. So you go to a good data set, they'll tell you which brokerage has given what EPS estimate or which brokerage has given which revenue estimate. And you can sort of do an analysis. It's a whole strategy in itself where I can sort of analyze which analyst does the best and sort of piggyback on their research. So there's a lot of qualitative stuff that right now maybe data is not capturing. In the future, AI will capture all that. Right? In the future, AI will probably, give you a summary of the management call and the bigger highlights as data points before, somebody can listen to it. But even right now, there's so many ways to sort of adapt to that. And I really believe that, there's a lot of wealth to it. And you can do it in a quantitative fashion, for sure.
I think the future that you're talking about, that is already here. Sankarsh is using AI a lot in his approach. So Sankarsh, why don't you talk a bit about AI, specific use cases where you have seen AI to be of value in the overall investment advisory space?
Oh, yes. So first thing, even on the quantitative or the qualitative space, AI is one of the enablers. It's one of the technologies or processes or whatever we call it. It's one of the ways of perceiving and solving that problem. That's not the only criteria at all. Of course, because that's a trend at this point of time, everybody's talking a lot about that. So in terms of qualitative, for example, I think that's where the real challenge is, because what happens is all quantitative models come back to the same problem, where the final intuitive decision on the quality is made by the fund manager again. So you have tried to remain unbiased till the last step, and then you add bias in the last step, basically. So again, all bias is not bad. Just because it's bias, it's not bad. We'll have to put that aside. But that's against the philosophy of what we started doing quant with. So in terms of iris, I'll give you an example in terms of qualitative. For example, I was talking to you offline as well, in terms of a particular management that has said in, say, 2018, that we'll be carbon neutral in 6 years from now, right? And firstly, there's not many people reading 6 annual reports of companies. And in 2024, there is no mention of that event at all, or that milestone. Now, it's very human nature to forget about it. So even if you have read 6 annual reports, unless you have made meticulous notes, you can't remember that, okay, they told me about carbon neutrality, and there's no mention of that here, right? So that's an insight that got missed. So that's where system can pick it up and tell you, you know what, 88% or 80% of the times, whenever the company didn't mention, it likely did not happen. Again, it's not very deterministic like that. Yeah, this did not happen. You can't guarantee that. Maybe they did it and it's an omission. But these are all probabilities that we're talking about. So those insights are what can be captured, basically. So the linguistic analysis, the contextual analysis, the text, and like unimaginable amount of data. We have a lot of fun doing American markets research as well, because the granularity of that data is amazing. You get those con calls, right? I mean, of course, we're getting that here as well, the real-time transcripts that are coming up. There is analysis of the voice of the CEO when they're speaking, right? There's an audio analysis. Are they confident about their earnings when they are talking to the investors? Things like that. So that's a depth that we are going to. I think that's the future, for sure.
Okay, Siddharth, now moving on to AI only. How have you been using AI in your strategies also? And also, I want to know your view about how AI can be used in the overall wealth management industry, not only from the portfolio construction point of view, but also business operations point of view.
So we actually at PL, we don't use AI. We have a man with machine approach where we believe two things. That the computers on their own have no real intelligence. So if the human wisdom is missing, how will the computer know what to do, or how will the system know what to do? So the starting point is, we are not using AI, we are using a rules-based, system-driven investment framework. That's what we do. The other thing is, do we intervene? Do we overrule the models? When I say man with machine, do I mean that the model tells me A, but I do B? No, that's not what man with machine is. Our entire job is to design the model, to improve the model, to enhance the model, but let the model do its job. Even if the model goes wrong, we still follow the model. I don't say, okay, I felt like HDFC Bank should have been in my portfolio 2 months back. It's not coming by my model. Let me just buy it anyways. We can go wrong even if the model doesn't give us the right decision. So we are okay with that. We are very, very strict in terms of following the model through the ups and downs, because it defeats the purpose, right? If you build a model and then you make your own decision, what's the point of the model anyways? Having said that, I think there are 3 key things we look at as a quant team. That the strategies we design need to have statistical significance, they need to have logical significance, and they need to have economical significance. Statistical significance means that the performance can't be random, it can't be by luck. Logical significance means that the rules that they've defined should make sense to us, our investors, and general market wisdom. And economical significance means it can't just be paper returns. The returns have to translate into real fund performance also, because it is very easy to generate returns on paper in a back test. So if we use these 3 filters, that logically the model is making sense, we've made 100 rules, 65 rules are very good, we keep improving those 35 rules based on our active understanding of the markets. Economically, the returns need to actually come to investors, not just ke paper pe aa gaya. And finally, it can't be
random or by luck. There has to be probability that, okay, on a rolling 1 month, 3 month, 6 month, 1 year basis, there is 60% plus probability that we are beating the benchmark. If we get that statistical confidence is when we deploy the money in that model.
So I've had actually quite a few questions written, but unfortunately that's the time that we have. Thank you all for coming out here and answering these questions. It was really very enlightening for me, and I'm sure for the audience as well. Thanks a lot. Thank you, everyone.
Thank you so much, Vivek.
Thank you.